Welcome to the Compass series of conversations with leaders charting a course in impact investing. I'm Ben Thornley, Managing Partner at Tideline, and in a few minutes it will be my great pleasure to introduce a fantastic group of panelists and practitioners. Thank you for tuning in. Please do use the Q&A function to ask questions, and we'll reserve some time during our discussion to answer them. Our topic today is labeling in sustainable investment, which has been a focus of Tideline's work for many years. Why? Because an investor's ability to accurately describe what they are doing is in itself a first and most important signal of impact integrity. Moreover, for allocators and intermediaries, the only way to properly match a client's unique needs to the right product is to have labels that really count for something. Without proper labeling, the risk of impact washing, unmet expectations, and impact underperformance is greatly exacerbated. Even the most seasoned professionals struggle with the alphabet soup of terms and definitions in sustainable investment, which is why Tideline has published frequently on the topic, including just yesterday, our new guide to using the impact investment label. Here are a couple of highlights. First, we describe what it means to dial up or dial down an investor's level of intentionality, contribution, and measurement. We found through dozens of client engagements that those three characteristics, the three pillars of impact investing, can actually be applied more broadly to distinguish other forms of sustainable investment, including ESG integrated investment and thematic investment. Second, applying this method, we have created a unifying framework that directly distinguishes one sustainable investment approach from another, and which can be used to map different strategies. Please do visit tideline.com to view that report. For today, helping to unpack impact labeling, we are fortunate to have with us 4 impact investing leaders who have been thinking about this question for even longer than Tideline. Mark Berryman is Managing Director of Impact and Sustainable Investing at Caprock, a fast-growing investment advisory firm with over $8 billion of assets under management, known as a pioneer in sustainable investment. Lauren Booker-Allen is Senior Vice President of Impact Advisory at Jordan Park, where she's spearheading the $17 billion firm's significant and growing commitment to sustainable and impact investing. Kelly McCarthy is the Director of IRIS and the Global Impact Investing Network's other market-shaping impact measurement and management work, essentially establishing standards for robust practice in this area. And Jamie Martin is an Executive Director in Morgan Stanley's Global Sustainable Finance Practice, which has been setting the pace in impact investing and sustainable investing for a decade, including with the launch of the firm's Investing with Impact platform in 2012. Welcome all, and thank you for joining us. Jamie, my first question is to you. The Investing with Impact platform created one of the first robust taxonomies in sustainable investment a decade ago. Can you remind us what the taxonomy is, and is it doing what you hoped it would do? What have you learned?
Yeah, absolutely. And thanks, Ben, and thanks to the Tideline team for putting this together and for inviting me to talk a bit about Morgan Stanley's journey on what you clearly identified as a ongoing, I think, challenge and opportunity in this space, which is coalescing around the definitions and building frameworks that allow investors of all different sizes and motivations to really understand exactly what their money is catalyzing towards positive impact. So, we've been at this for quite some time. I sit in the Global Sustainable Finance Group at Morgan Stanley. And we've really been the strategic partner with our wealth management business to build out what you referenced, our Investing with Impact platform, starting back in 2012. We had the insight then that, again, sustainable investing, we use as the umbrella term, is not just one thing. And we found it helpful to publicly launch a framework to categorize different funds and different investment opportunities that we were starting to see come to market, really across kind of that spectrum that I think Tideline has really taken to the next level. So that was our original version, and it included terms like restriction screening, simply avoiding objectionable investments, or sectors or exposures, ESG integration, which has obviously become quite popular across all asset classes, using environmental social governance information as an input into the investment process, thematic approaches around climate, gender diversity investing, and finally impact investing, which at that point we thought about mostly in a private market context, with kind of companies and funds intentionally investing in companies that were solving or addressing social or environmental challenges. And so again, what we use that for is really just to help map the different funds and opportunities on our platform to those approaches. And also for our clients, we have very diverse client base here at Morgan Stanley. Nearly 3 million household accounts that have just as they have very different financial goals, they have very different impact goals as well. And we thought providing that spectrum and that definition really just helps people have a much more informed conversation, and helps our advisors ultimately tease out what their clients are trying to accomplish when they want to engage with our Investing with Impact platform. Fast forward to 2021, and we've actually recently evolved that spectrum, that original Investing with Impact spectrum that I described, to what we call the 3 I's of impact. Again, these are words that I'm sure will come up throughout the hour today, but our I's around Investing with Impact are intentionality, influence, and inclusion. And really those 3 I's of impact, again, they can be mapped to almost every part of that spectrum that I originally described. But I think that idea of intentionality that Tideline uses, really trying to understand the asset management's investment process, right? If the portfolio manager and the investment decision maker can't describe how a focus on ESG or focus on impact actually adds value to their investment process intentionally, that's a red flag for us. And so we're very focused on a series of questions to answer that we'll get into. We made space to really elevate and emphasize inclusion, diversity inclusion, and a focus on DEI through fund ownership and/or portfolio management or manager representation. And then finally, this idea of influence. Again, I think that's, asset owners, investors of all sizes are realizing their influence in the market to mobilize capital to a more sustainable and just economy. And so the asset manager's use of active shareholder dialogue, proxy voting, resolution filing, and others really to encourage sustainability and promote it and unlock value inside investment holdings as well. So intentionality, influence, inclusion, again, we can unpack those as we move on here, but that's our new framework, and we're finding our clients, regardless of their sophistication levels around impact, providing a helpful framework to navigate as this all evolves quite quickly. And I'll pause there. Thanks, Ben.
Fantastic. Thanks, Jamie, for sharing that, and we'll be excited to learn more about Morgan Stanley's new approach. Lauren, to you, it would be great to understand Jordan Park's approach as well, and what you're solving for in client relationships by trying to get clear on terms and definitions. And have there been any tools that have been especially helpful for you in doing that?
Thanks, Ben, and thanks to the Tideline team for having me. Really humbled to be with this great group of panelists. So just to step back, Jordan Park was founded in April of 2017. So very humbly, we are earlier in our journey than many firms, but we were very intentional about ensuring that impact was going to be a key pillar of our business. It's important to our clients. It's important to our team. So we've been very busy trying to integrate that lens and those capabilities across the firm. As it relates to our approach, generally, we really try to start with what issues clients care most about. What are their values? What are the problems they're trying to solve for in the world? As we know, what one client's issue areas that are most interesting look very different from another's. And so it's our job to help them understand what's possible across that broad impact spectrum. So we've been very busy trying to build out capabilities across asset classes, from traditional to ESG, impact investing, and philanthropy. The problem solving first tool was definitely inspired by a lot of the experience that I had from Midyar. But beyond that, my team comes from Heron Foundation, deep nonprofits, Cambridge, Imprint. So we really tried to bring some of the best thinking from some of these other pioneers in the space. What we found to be pretty critical is the framing along that. We wanted to be very intentional, to Jamie's point, and transparent and consistent with how we frame what's even possible and how we articulate what those opportunities look like across that spectrum. And so when we think about just the difference between the range of risk return and impact characteristics of any of those investment strategies, or even what's possible in philanthropy, it's really important to bring clients along in that educational journey. We have been huge fans, as many on this call are, of the Impact Management Project. A super valuable framework for us. It's been wonderful to see over several years now, the 2,000 plus practitioners really converging to see this as an important industry standard. So we've used it, and particularly the ABC framework, avoiding harm, benefiting stakeholders, and contributing to solutions, to be really thoughtful in client educational materials, IPS creation, portfolio construction, and then full circle with IMM and reporting. So we're excited to be in this journey, and we're learning a lot.
Great. Thanks, Lauren. And Tideline too is a serial user of the Impact Management Project, and certainly this framework sort of aligns with the ABCs. Mark, turning to you and CapRock's journey in this area, how do you distinguish approach to sustainable investment? And building on Lauren's comments, for CapRock, how has that clarity mattered in your work with clients as well?
Thank you, Ben, and great to hear about the new framework at Morgan Stanley, and always interesting to hear about what Lauren's up to at Jordan Park. First, I'll hit on our tools and processes and how we distinguish and why it's important. Many of you know CapRock has been involved in impact investing for well over a decade, and we have a portfolio of shy of 50 million private impact funds on our platform. In terms of tools, many of you know CapRock uses an impact reporting framework and software called IPAR. And that allows us and our clients to monitor impact performance of an investment and see side-to-side comparisons of how, let's say, a sustainable forestry fund generates impact results alongside, let's say, a financial inclusion fintech reports their impact metrics. And it's here where we're able to break out impact by theme, people, climate, and resources. And within those, you're going to have various sub-aspects such as access, think of affordable housing, education, healthcare, financial inclusion. For people is one of our main themes, or climate and resources, which are two other themes, where you're going to have underlying aspects of conservation and efficiency. And then these are using various impact metrics. And we first and foremost build off the IRIS metrics that were put in place years ago. In terms of process, just like my peers here, we do conduct an impact due diligence, and we have dedicated DDQs and assessments. But a second step, which allows us to ensure a little bit of, not a little bit, but discipline in the impact reporting for all of our investments, is impact reporting side letters. And this is actually a condition for commitment or investment for all of our clients who may consider an impact investment on their behalf. And so what this does is this ensures that we will have a set of clear impact results and metrics to monitor over the life of that investment. And so that's just very important of why this matters for our clients. Now, in terms of distinguishing between approaches, I'll simplify this and say that for public equities, and I think Jamie was alluding to this, for public equities and the majority of our fixed income strategies, we do classify these as ESG and not impact, despite a public equities fund being marketed as an impact public equities fund. For CapRock, this is more of a values alignment process for our clients. Now at CapRock, a clear investment strategy of ours has really been in the private investment broad category. And in that, you're going to have the asset classes of real assets, where there's lots of really interesting sub-asset classes for climate, but you're also going to have private debt, private equity, venture capital, co-investments, and alternative credit. It's within this group where we will label and classify a fund as impact. And the decision for us to pursue one of these impact marketed private investments will depend on the level of intentionality. Now, that's how we label and classify. Now, sometimes we'll present something as high impact to our clients. An example of this could be, let's say, Water Equities Global Access Fund, which is essentially access to capital for low-income communities and frontier markets to access affordable, clean water and sanitation. But we also have within this broader private impact category of ours, we'll present something, not classify, we'll present something to our clients as impact light. And this may be to set expectations. And there's nothing wrong with that. We probably have 2 or 3 within our under 50 private impact funds that are labeled, or I should say presented as impact light. What's important is, can they provide measurable impact metrics? Can they defend? And yes, this matters for our clients. We want to be fully upfront and transparent of why we are going to present something as impact to them. And I'll conclude with, I like this thematic label aspect that is in Tideline's framework for labeling, as it might be an area for us at Caprock to explore when we really try to hone in on these things presented as impact light.
Great. Thank you, Mark. Kelly, what is the GIN seeing and hearing from the market regarding sustainable and impact investment labeling? Like, what are the competing incentives and pressures to broaden or narrow or get to greater clarity on terms and definitions?
Thanks, Ben, and I echo the thanks to Tideline broadly for having this conversation. It's incredibly important, and it's something that for those that don't know the GIN, we're dedicated to increasing the scale and effectiveness of impact investing, and this work, I think, precisely sort of helps kind of nudge the dialogue in that area to create some more conciseness and specificity. Ben, to your question, this is a conversation that I think investors have been grappling with for at least as long as the GIN has been kind of working on this work as well. And I think it really comes down to the need to figure out ways to differentiate one's approach. And what we're really starting to see, the conversation has really evolved. And for those on the line, you might remember, there was once a real focus on, whether or not impact investing, for example, was a distinct asset class. And that kind of evolved to whether or not there was sort of a spectrum of ways to approach investment, and one of which on that spectrum was impact investing. And I appreciate personally very much that we're getting to the point of we're talking now not about descriptions, but we're talking about something that's concrete and actually something that can be validated, verified, and assured. Because I think, Ben, you opened this conversation talking a little bit about, integrity, and I'm assuming that we'll probably touch a little bit more on that later. But what we're seeing in terms of what the market is really asking for is a way to trust that what products are being offered, a way to trust that what investors are saying they're doing is actually in line with the real practice and performance behind those products and offerings. A couple of things I want to kind of talk about here that I think is important to touch on. It sort of sits behind what's driving this. And I think there's sort of three pressures, and these pressures are going to, just in my view, sort of change as time evolves. And those pressures are regulatory, marketing, and market. And I'm going to distinguish the last two. I'll just touch on this quickly. But from a regulatory perspective, one thing that I'm personally excited about is that there are movements to actually codify what I'll call a floor. And that floor is very much including many of the ESG practices, definitions, measurement, intentions, contribution that have been actually written about in the report, Ben, and I really appreciate how that's been framed. That floor is basically setting a minimum expectation. And I think it's really interesting to watch that in terms of how our definitions and labels evolve. The second piece, and I'm happy to elaborate on that a little bit more. The second piece of that is marketing. The need to differentiate based on competition performance amongst a field that has so many high performers is obviously present. And in the past, I think we saw a lot of differentiation based on again, descriptions and the best sort of sort of internal proprietary way of approaching something, but now we're looking at competition actually based on performance and practice. And so that's, where marketing comes in, is the need to differentiate based on something that has some teeth to it. And then the final one is market. And this is one that I think is really interesting for this labeling conversation, because one thing that I've seen is that this discussion about ESG impact, the thematic, evolves concurrently with the urgency and imperative of the expectation on business and investors to address world's problems. So as that urgency and imperative starts to become more critical, you're going to see more focus on sort of a shift in that dialogue. So for example, I would say ESG really focuses on stewardship, and I know and everyone you definitely should read the report. But what I really like is this description of the ESG piece focusing on inputs. That's really stewardship. It's like, are you running a good business? And then you kind of push along that spectrum, and you're like, you're asking about impact, and that's really about transformation. It's really about, can we actually transform the world in a different way that's better? But we're going to see more, and this is label-less, but as our issues become more acute and urgent and critical, we're going to see a lot more conversation around, regeneration, renewal. Can we right wrongs? And Jamie, you talked about a new sort of I, which is all around inclusion. That people weren't talking about it the same way 5 years ago as they are now. And as these issues become more urgent and acute, the bar and the definition and the labels and the inclusion of that is going to change. Hope that's helpful, Ben.
Yeah, really helpful. I love, Kelly, that you're connecting what we're seeing in the market and the needs we have as a society to the importance of things like labeling, in order to get clear on, how we can authentically and rigorously address those challenges. So really appreciate those comments, Kelly. Lauren, I wanted to come back to you. You emphasized the crucible where Jordan Park and the client are together trying to figure out what a client needs and wants. So I wanted to ask you what clients are asking for, and whether, as you go through your framework or use the ABCs, whether clients are really understanding that those terms and definitions imply different outcomes. So do they know what they're buying?
Yeah, it's a great question, Ben. So one thing I would say is, the client interests and where they're at on their quote unquote impact journey ranges incredibly. And so we're really excited, because we like to say that the significant majority of our clients are impact oriented. So whether they're leading with an investing lens or a philanthropic lens, it is important to them. And so what we see from the folks that are earlier in their impact journey, and by the way, when we say that, that could be folks that are just even newer to investing. They might be newer to impact as a concept. They're certainly newer to ESG impact investing, but they are just really excited to learn what's possible in their portfolio. We see a lot of folks who have been leading with the philanthropy side, when they're like, oh, wait, there's all of these other things that we could do with the 95+% of the rest of our endowment, for instance, and some of the foundations that we oversee. And then we have our clients who are much later, much more sophisticated as it comes to their impact journey. And so they continue to push us. They help us get better. They're asking for the more sophisticated products. They're also helping us internally. Again, we're earlier in our journey. They're helping validate a lot of the theories of change that we had as it relates to, the business case, our model. And it's really great, because they're also able to help others who are earlier in their journey just see what's possible and get access to more investment strategies that they might not have been thinking about previously. So I'd say, if we step back, our general goal is, how can we marry the best of portfolio construction and asset allocation with where we can, quote unquote, dial up? I think, Ben, you mentioned the ESG or impact profile across asset classes. As Mark referred to, we know what's possible in public equities versus high yield credit versus venture is incredibly different as it relates to impact. So it's really important for us to go back to that client education piece. The other part is, we're not evaluating impact in a silo. We can't. Based on the fact patterns of the clients that we serve, We're thinking about, their liquidity needs, tax implications, the difference between their goals and their personal versus their philanthropic portfolios, market inefficiencies and efficiencies. So we're product availability in the sub-asset classes. What I will say finally is the beauty of the IMP and the ABC framework, because it's so simple, no matter where clients are at in that journey, super early or super late, what we've been excited to see is all of them are asking, well, how can we move further to the right? How, this seems like low-hanging fruit. We should be able to move from traditional to A, at least in this category. Well, how can we get more A's into the B's? And we're like, awesome, because we obviously want to see more inspired and equipped capital moving further to the right.
Well, that's exciting, Lauren. Thanks for that. And Kelly, you may have been intending to mention it, but we're excited to at Tideline to see the impact classification system come under the GIN umbrella. And so I think for folks tuning into the call, I'm sure that ABCs will become a term that becomes more familiar and ubiquitous in our work together. Mark, turning to you and focusing on the managers that are coming through your door, the funds that you're diligencing and looking at, do you see them upping their own game on labeling? And what's your view of the level of integrity in the market at this point? And then a second question: how can you, as an allocator and intermediary, influence managers to further up their game?
Good question. And on the first part of it, on are we seeing funds up their game on labeling? Yes and no. So obviously there are some well-known private impact managers who have been around for well over a decade and they're on their fifth fund, and then don't necessarily need the impact on in their title on the cover of their marketing material. But we're seeing some folks and some new managers come up with some interesting labels, such as I've heard Impact Plus, Impact 2.0, Impact Disrupt, or things in climate tech calling, resilience tech, renewable tech, or as recently as yesterday, a dark green fund. So, again, all of this is fine, but it goes back to that core principle that they still need to provide measurable impact metrics that they can defend for each and every investment in a portfolio that they will construct over the life of that fund. There's actually some well-known managers that actually invest in companies that have impact potential. And again, that's totally acceptable, if we know the manager is going to work with that portfolio company to build on it and prove it. I think a very good example of this is, HCAP or Bain Capital. And again, that is totally acceptable. So as long as they're very clear, there's integrity and there's intentionality behind it, and they can defend it a few years down the line. In terms of how can allocators have influence, numerous ways. I'll just provide two examples. Number one, impact reporting side letters, something that we've been doing for a long time, and it's a process that I took with me when I used to work at the IFC. But the more allocators that do this, the better we will be in terms of ensuring that all of our impact managers are going to present measurable impact metrics to prove their case over the life of that investment. Second is impact verification, and the work at Bluemark is setting the groundwork for this to become critical in order to avoid impact washing in the future. And that is a growing concern as the day goes by at a firm like Caprock.
Great. Well, thanks, Mark. And then Jamie, just to continue along that thread, perhaps to even dive a little deeper into the way Morgan Stanley is diligencing managers. I'm just curious how much more sophisticated your practices are becoming in terms of scrutinizing the kind of labels that are being put in front of you. And are you distinguishing, is that a real focus of your diligence process, distinguishing between different types of sustainable investment approaches?
Yeah, absolutely. I think, since, day one of the Investing with Impact platform, our tagline was always, for something to be improved for investing with impact, it has to go through the same diligence process as any other product that Morgan Stanley distributes or offers. And I think I would argue now there's even a greater level of scrutiny around this. I think I mentioned, the evolution of our framework. I think that reflects the evolution of the industry. And I think, others have touched on it, but right, I mean, there is no such thing as a perfect company. Hence all the work that, is not done after a portfolio is invested. And that really speaks to that influence. So we spend a lot of time understanding how asset managers think about that influence and that power around stewardship that they have as an active owner. And then, we're thriving for better, diverse representation at the asset manager level. Right now, again, these stats are well known, but less than 1.5 professionally managed assets in the U.S. Are managed by a woman or a person of color. And so, Morgan Stanley, we have scale. And so if we can be more intentional about the asset managers that we select, the ones that we highlight with our clients, that can make, we think, a difference. But we have to educate our clients about what is in the realm of the possible, and that's where the framework comes into play. And just to put some numbers around it, I think we've got about 180 strategies on our Investing with Impact platform. 100% are going to take that intentional approach. That's what it's really all about. 70% exhibit some sort of influence, and you could think about that in the private and the public markets, probably mostly in the public actively held strategy, and greater than 20% have a diverse owned asset management firm, product that they're offering. So, again, there's some work to do there. Just two other things, and I guess there are two R's I would bring up. Kelly touched on regulation. I think that's, again, a key one, certainly what's happening in Europe with SFDR, the Sustainable Finance Disclosure Requirements, is having a big implication if you're an asset manager that sells or markets funds in the EU. You will be adhering to that. And, there's, I think, kind of a flight to the top that'll happen. Again, I think global asset managers are going to use that to really set their standards, and that's going to have implications globally on how these funds are transparent about what's actually happening inside the funds. And so I think, that is going to have big implications going forward, and it'll be interesting to see if some of that trickles over here to the U.S. And then finally, the reporting aspect. And I know, CapRock is certainly on the cutting edge of this with IPAR, and I'm sure Jordan Park is very sophisticated ways to ultimately communicate to our clients the impact in the portfolio, and that's very challenging, right? And I think the categorization and the tagging and the marketing of funds plays into that. If every fund had a commonly agreed upon approach, we could then kind of aggregate that, bring it to the portfolio level, and make a summary type statement about what's happening inside the portfolio. But impact, it's not one number. Clients, when they get their financial statements, we joke kind of, they start at the bottom and then they go up to the top and see where either the problems or the good things are happening. Impact reporting is a different. It's quantitative, it's qualitative. I think, the IPAR system, and, basically, and Mark can keep me honest here, but you got to go to every asset manager. You got to understand their approach. You got to bring that into the system. You got to synthesize it, and then you can get it to the portfolio level. We've done a similar proprietary tool here at Morgan Stanley called Morgan Stanley IQ. And it's a lot of work to get all this information to that aggregate level, and then ultimately be able to really x-ray a portfolio and make a determination if the portfolio is aligned or unaligned with the client cares about most. So that's something we've worked on with Morgan Stanley IQ. And I think, again, the classifications, as this all evolves, you would hope, bring some more efficiency to that process, and perhaps some more focus for folks to really understand what is happening in their portfolios that are focused on impact.
Great. Thanks, Jamie. And Kelly, Jamie had mentioned the new sustainable finance disclosure regulations in Europe. I'm curious your view of how formal and prescriptive labeling and definitions will become. Do you see more legal requirements emerging in the market, and is that a development that Jin supports?
Thanks. So, one of the things that we're seeing with SFDR specifically, and Jamie, you just touched on this, but for everybody on the line, anybody who does business within the European context will have some effect that is kind of drawn based on SFDR regulation. And that's, really about classification, and classification for the purpose of, really understanding what, where someone's accountability lies. And, we've talked, Lauren, you've mentioned a couple of times the ABCs, and Ben, you've had, a very significant hand in developing that thinking. And we are very supportive of more clarity around, intention, contribution, and measurement. Those are things that we stand behind very firmly, and think they're incredibly important ways to really understand, where the investor's focus is, and again, what one's accountability or influence sphere includes. In terms of, I just want to touch on a couple of things that other panelists have said. I think one of the challenges with the labeling conversation is going to be, because we're talking about issues, because we're talking about live issues, in the world, and the world changes, it's dynamic. Our definitions are going to shift along, as I mentioned earlier, along with the imperatives and the agenda and the urgency of those issues. So again, regulation, I think, is incredibly powerful for establishing a floor. And sooner or later, the things that are included within that regulatory floor are going to be just what is expected of business. And I say it's about time. I mean, some of these ESG things that are being included in SFDR, and we're talking about, it's like we should have been doing this for the last 20 plus years. I mean, it's basic good business, and it's been proven time and time again. When you start to look at some of the other issues, as norms are established, there's a whole bunch of things we're talking about in terms of DEI. These are things that should not be special. It should not be special. It should not fall in the spectrum of impact. It should be something that's expected. But because it hasn't been so, they are special. But I guess the point of me sharing this is because I do think that the labeling challenge will evolve as issues become norms, expected, and there will be new issues, there will be new imperatives, there will be new global pandemics that, that draw to the surface things that we need to address urgently as a global community, and those will fall, again, in a further end of the spectrum. So, as I say that, I think labeling is incredibly important. We stand very much behind, the efforts to do so, but also, with this idea that there is a fluidness that we have to acknowledge and think about how we're going to support that fluidness so that we continue to drive towards, as Lauren, you were mentioning, people want to do more, but how do we continue to drive that along that path?
Great, thanks, Kelly. And we've had some great questions come in from the audience, so we're going to turn to those in a second. I also just want to acknowledge Lauren's market shaping role over the years. I think when Lauren was at Ahmed Yar, made an anchor investment into the impact management project, and really has been at the cutting edge in these conversations as well, which we really appreciate, Lauren. So turning to the questions from the audience, and the first, I think, Mark, maybe this follows on from some of the comments you made, but would welcome contributions from others as well. What would it take to get to more consistent labeling? I mean, we talked about regulatory pressures, but would it be helpful for you if, Tideline's framework or the ABCs were consistently adopted, and you could really rely on managers coming to you with a consistent label rather than deep green and other descriptions that you had shared? I mean, would you want for funds to be consistently labeled? Would that be something we should aspire to? And if so, how do we get there?
Yes, I think it would be incredibly helpful. The one thing that is always challenging is the level of subjectivity will differ in everyone's eyes. And beauty is in the eye of the beholder. And in some cases, unfortunately, impact has been in the eyes of the beholder. And an example would be, some people think sustainable CPG companies our impact. And if you can, again, measure it and report it and defend it, great. But in some people's eyes, that's not doing enough. And so that may not meet the muster of what should be labeled as impact. That will be a challenge that we will have to go through forever. And again, that's fine. But I go back to that principle of an impact manager's ability to invest in companies where they can identify and measure impact or impact potential and be able to measure it, defend it, and report it with conviction back to its respective investors. So if folks can come together and there be consensus around a label, that would be incredibly helpful. And again, you add on the impact verification aspect of it through the work of Bluemark, even more so. So a long answer to the answer is yes, I do think that would be a huge step in this process and for the benefit of our industry.
Okay, great. Lauren, thanks, Mark. Lauren, we've had a number of questions about impact reporting and impact measurement. So I just wanted to ask you that question of how you're going about that, whether there are tools that you're using, how you come to agreement with your underlying managers of what they're doing, and whether they have the resources to do it or not, and how Jordan Park can support in situations where they might not. So just a little bit more on the way you're doing impact measurement and reporting.
How much time do we have? My goodness. I mean, I will tell you, it continues to be a beautiful labor of love, and one that we knew up front we were going to have to get this right. So we've been iterating quite a bit. We actually launched our inaugural impact report earlier this year and did a pilot with a few clients who were really excited about it. I would say that there's a few components. And honestly, the North Star for us would be, look, if there is one way of showing a client's impact, quote unquote, and I think, as Mark said, impact's in the eye of the beholder, there's so many different ways that you might classify it. And we would love to do that, not just across investing, but on the philanthropic side as well, all in. And so we've been trying to Frankenstein this a little bit, at least in the interim, because there's not an off-the-shelf opportunity to do that. So we have our kind of a proprietary way of trying to aggregate some of those things across the portfolio. Again, to not belabor, but the IMP framework is at least a helpful tool up front to do some of that differentiation. But then when we're looking at the underlying strategies across asset classes, we do have to work very closely with our managers to make sure that there is some integrity in what managers are able to report on, how consistently they can report on those things. As it relates to even just our private investment managers, it's really hard because they're all on their own impact reporting journey. And so I know that Mark and Jamie have touched on this, but we try to make sure that, there's no hard and fast rules, if you will. And I think I saw a couple of questions on, do you fund some of the organizations that are, if they're philanthropic or otherwise, that are trying to be better at impact reporting? We like to think about a few different principles here. One is just the intentionality and the commitment, right? Some of the earlier stage funds, for instance, they don't have necessarily all of the tools and the capabilities in-house yet to have robust reporting, but we want to see that, they're doing something and there's some intention and journey that they're kind of aiming towards. We also like to see alignment. I think there was a question in there around, how do you do this alongside financial reporting? We like to see that integration where possible. We'd love to see, so for our directs or co-invests, what's the alignment and the core KPIs in your business success? To the extent that those things are one and the same, you shouldn't have to have this entirely separate sense of impact metrics that you're tracking against. And flexibility. There's not a one size fits all for the different underlying investment strategies. So we try to be thoughtful about the modularity of the frameworks and the metrics that are out there, because what's going to work for a climate fund who's looking at, tracking some metric tons of carbon in like one really lovely way versus a multi-sector fund that's looking at education and, health and wellness, and aggregating that at the portfolio level is tricky. So we try to work with them. And then as the intermediary to the client, we try to do that one step higher. So long-winded, but hopefully.
No, thanks, Lauren. Very, very helpful. Jamie, a question to you. I think we had a question come in that had asked how you verify and assess a manager's degree of influence further to your 3I framework. And then on top of that, we had a question of what it would mean, Mark, for a manager to be impact heavy versus impact light. And so perhaps, Jamie, I'll direct that question to you as well, and then would offer the opportunity for others to add on. But Jamie, to begin with that question about how you measure and verify influence.
Yeah, I mean, yeah, again, influence is hard to get down to one number or one metric. I think, frankly, what we're looking at mostly there, and I'm talking mostly in the public market, active strategies would be track record of success, right? Has this asset manager successfully raised sustainability or ESG material issues with a company, and either either kind of through the more formal proxy voting and shareholder engagement channels, or even some are a lot quieter about how they're using their power as a large shareholder inside a publicly traded company to influence management to take sustainability issues seriously. And so again, I think as alluded to, there's managers that have been doing that for 25, 30, nearly 40 years now, very successfully. They're getting a lot more attention now. The other aspect around all this, other acronymed organizations, it's easy to bring them in, but there's a lot of coalitions that are being built to really, I think, even raise more louder voices with asset managers and asset owners. Some of the large institutional investors, whether they're pension funds or family offices or sovereign wealth funds, signaling how important these issues are to how they're managing their long-term pools of capital, and asset managers responding to, again, take this to the highest level with the companies that they're invested in. So I think, again, there's, not a particularly hard metric to quantify that, but there's a lot happening, and I think it's, increasingly falls on us to help our clients navigate that. And then if our clients want to vote their own shares, that's something that we can, assist them with and give guidance to as well. And then, on the impact light versus kind of, impact dark or the spectrum of green, I mean, I think, again, there are different ways to kind of conceptually think about this. We try not to be overly prescriptive here, right? We're not dictating, this is the most impactful strategy you can possibly have and the most impactful portfolio. It's really about giving our clients that spectrum and pointing out that the ones that are the most sophisticated are actually taking bits and pieces of each strategy and calibrating it towards the impact focus area that they're focused on, that they want to really accelerate their capital towards. And so I think, again, I think there are these labels out there. I think Kelly had a great point on the marketing side, right? I mean, asset managers are looking to differentiate. It's gone much farther than just putting windmills and pictures of people holding hands on the cover of your prospectus and kind of calling it a day. And so that's what we're, I think really trying to suss out in our diligence is, on that spectrum, ultimately what are the outcomes that your strategy is trying to achieve.
Great. Thanks, Jamie. We've had a question about the relationship between Tideline's labeling framework and the ABCs. The ABC is an outcomes classification system. The labeling framework is intended to hit at the core terms that managers are using to describe their strategies. So, we do expect that managers will classify against both. But Kelly, I just want to clarify too with you, what's your view on where the ABC sits versus these more common terms we're talking about here of ESG and impact and thematic investment?
Thanks, Ben. So, for those on the call that may not know this, so Ben touched on it a little bit earlier. The GIN has recently assumed management of the impact classification system, which allows for a greater sort of a walkthrough, as it were, of how you might use the ABCs that we've been talking about. And that will be available to use within the Iris Plus system, and allow for, there's about 20,000 users there. So that will allow for those 20,000 users representing around 11,000 institutions to classify themselves according to the ABCs. So that's just to underscore that, we are really supportive of this progression in the market. And how does that relate to these other things that we're talking about? I very much agree that it doesn't cut sort of in perfect lines along an ESG label or a thematic label or an impact label. There's a lot of different sort of, I don't know who used the word dial up or dial down ways that some of those different areas can fall into, one's intention, one's contribution, one's, how deep one is actually measuring and proving that they are actually having they're progressing along the lines of what they set out to do. To connect also with some of the regulatory work, what I'm really pleased to see the ABCs actually do a pretty good job of helping with the SFDR, Article 6, 8, 9 sort of bucketing. We're very interested in making sure that's a lot more clear. And I do expect, by the way, the US, the Biden administration has prioritized ESG. There's movements in, other global sort of stock exchanges to emulate what's going on with the EU taxonomy. So, I definitely think this is something that we are going to expect more of and need to continue to support investors in that activity. But the good news is that all this good work that's been done is really helping to push it along in that direction.
Great. Thanks, Kelly. Well, I think we're almost out of time, so I'm going to do a bit of a lightning round of questions now to each of you, and to end the call. And I think we will be also posting a recording of the conversation before too long on tideline.com, and certainly we'll let folks know how to access that. But Jamie, Lauren, I was going to begin with you. There are many managers on the call, obviously curious about the way Morgan Stanley and Jordan Park are assessing their own practices. And I'm curious in your view of what the kind of minimum viable level of discipline is that you would expect to see from funds that are pitching Jordan Park and Morgan Stanley. Lauren, perhaps you can begin.
Thanks. I would say kind of our first order of business is to just ensure that, there's authenticity and intention behind what the actual investment thesis and strategy is, right? It's a little hard to fake it. And I think everyone on this call, and I know a number of people who are entering this space, impact washing is a concern. And I think some of us have a really strong nose for when we call BS. And so we are very thoughtful in our rigor and due diligence. And so it's important to just look under the hood, assess the history, the track record, the team, the knowledge, the learning as it relates to all things impact. And we always say, like, impact investing is still investing. So clearly you should check the box of just having a really thoughtful investment thesis, but all of the additional impact diligence that's required there, it makes it that much more critical in our space to get that right. So I would just underline some of the points I made earlier. We don't have hard and fast rules, but we do want to make sure that funds are being thoughtful about their commitment and their intention to impact measurement, management, and reporting. We're okay with the balance of quantitative and qualitative. One without the other is pretty hard, especially given that clients absorb information very differently. And again, we want to make sure that there's an alignment and integration as it relates to their broader financial reporting and the flexibility of what works for them. If it's IRIS metrics, if it's some kind of a framework, I would love, and Kathy Clark, I saw your question, that consistency in labeling would make all of our lives easier. And as the industry continues to grow up, that continued infrastructure, I think to Kelly's standpoint, it's just going to ensure that clients have more understanding of what's possible. And Sarah Kearney and Maggie Cutts saw your questions too. That gets more capital moving into the catalytic part of the equation. And we're excited that, folks like Prime and Impact Assets and CapShift and others are really pushing the bar there too.
Right. Thanks, Lauren. Jamie, same question to you. What do you expect as a minimum viable?
Yeah, no, I mean, I thought great answer from Lauren, and Mark had a real good crisp answer on that before too, right? I mean, again, we're looking for the manager to articulate their focus around impacting ESG and ultimately be able to report on it consistently and credibly. And it's about authenticity, and that authenticity is subjective, I think. But I do think, yeah, as Lauren alluded to, right? I mean, that's where there's a lot of focus with our respective firms on unpacking that and also monitoring it going forward, right? I mean, we've also had examples of taking managers off our Investing with Impact platform because we have not been impressed with their ongoing commitment to this, and that's also an element. And I think we've actually now used the Morgan Stanley IQ tool with our diligence process to, again, making sure that we're keeping tabs and regularly checking in with the managers and the progress that they're making. And I think, again, in terms of kind of the new frontier, again, the blending of this, Lauren mentioned the integration of investing and philanthropy, and this notion of catalytic capital is a very powerful concept. I think, Prime and Breakthrough Energy Ventures and some others that are just, really reinventing the way that capital can be mobilized at scale that's needed to address these systemic challenges is something, again, we've got to probably think about a new framework to help folks kind of understand that and engage in it and wrap their heads around it and ultimately mobilize their capital behind it. But I think, we're encouraged by the direction that's all going and some of the progress that's already been made. And I think, again, it's about kind of the mainstreaming and the scale of that an organization like Morgan Stanley can bring to bear that we're pretty excited about.
Right. Thanks, Jamie. And shout out to the Catalytic Capital report on the Tideline website as well. Mark, and then Kelly, I'll give you the final word. And I was going to ask you both how you're feeling about the state of market integrity and where we're headed. Are you feeling the glass is half full or half empty?
With groups like the folks in this call, we will only make it better day by day with all the great work that firms like Morgan Stanley and Jordan Park and the GIN are doing. That being said, we continue to be more concerned about impact washing. And if I can be a little bit controversial towards the end of the call here, I think a few years ago, many of us were concerned about the large scale PE folks coming in and thinking they were wrapping funds with impact on top for fee grabs. But in many cases, not all, their reputation risk is so big that if they get it wrong or they're nefarious, that is going to have an adverse effect on these big players. What's concerning, and again, this is the controversial part, is some of the early trailblazing venture capital funds, as they've evolved, I'm seeing some of them veer away from pure impact. And what they may do in a beautiful glossy impact report at the end of the year, it may hide a few investments that have no impact whatsoever. And they'll highlight the 3 to 4 really good ones, and that's great. But I get concerned about things like alcohol companies or co-working spaces that are wrapped in really well-respected impact managers. And I love what Jamie said is we have started just to say no, even to old funds that have been great performers to date because of those issues.
Great. Well, thanks, Mark. And Kelly, the final word to you. How are you feeling about the level
in
of
30 seconds?
Yeah, exactly.
I am an eternal optimist, as those that know me know. And so I'm, very, very positive in terms of where the market is moving. This is kind of a life passion work for me in any way. So moving us along the lines of greater transparency, greater accountability, a greater focus on impact, and a greater focus on what investment can do to positively change the world. We're going in the right direction. That being said, here's my concern at the end of the call and sort of a call to action. I don't, and this is in my role as a standards body, I get concerned that the further along the spectrum we go, those that are trying their hardest to be, to measure, to contribute, and to back up their intention with real information, are subjected to way more scrutiny than the less sort of impressive actors. And there's a balancing act that we're going to have to find to help make sure that we're fostering the positive behavior and not punishing it, as it were. So that's sort of my call to all of us, is to figure out that fine balance to keep nurturing that piece along.
Well, thanks so much, Kelly. And thank you to all our panelists for joining us for this excellent discussion. A quick shout out to the Tideline production team, Olivia Lafond and Dmitry Iaselovich. Thanks so much for your help. Thanks for joining us, and we'll look forward to seeing you at tideline.com. All right, bye for now.